Ever wondered why your hard-earned money could be working harder for you? Curious if there's a safer or more fruitful destination for your cash than your local bank? If you're nodding along, then this video is for you. Welcome back to our channel. In today's video, we're unpacking 6 assets that could offer better returns and potentially more safety than keeping your cash in traditional banking institutions. But first, don't forget to hit the subscribe button and turn the notification bell on to stay updated with our new content that will surely help and guide you along your financial journey. So, you've worked hard for your money, and naturally, you want it to work hard for you in return. For many, this means stashing our earnings safely away in a bank. It seems sensible, right? Banks are secure, easily accessible, and they keep our money safe from physical loss. But what if I told you that keeping all your cash in the bank might not be the best strategy for growing your wealth? While banks play a critical role in managing our day-to-day financial needs, they may not always offer the best growth potential for our money. In fact, with the historically low interest rates we've been experiencing, the return you earn on your savings in a bank might not even keep up with inflation. This means that over time, the real value of your money, the purchasing power it holds, could actually be diminishing. This is where investing comes into play. By investing your money in a variety of assets, you give it the potential to grow, sometimes significantly, over the long term. You're essentially putting your money to work, and in return, you aim to grow it beyond what would be possible in a traditional savings account. However, investing isn't without its risks and complexities, and it requires thoughtful considerations of numerous factors. That's why it's so crucial to understand different types of assets and how they can play a role in your financial strategy. So today, we're going to delve into 6 assets that could be safer and offer more potential for returns than just keeping your cash in the bank. Now, if this sounds like the valuable information you're asking, show us some love by hitting that like button. As we unpack each asset, feel free to share your thoughts in the comments and don't forget to share this video with your friends. Let's dive in. Government bonds. Now let's consider our first asset class, government bonds. A bond is essentially an IOU between the bond issuer and you, the investor. When you buy a government bond, you're lending money to the government in exchange for periodic interest payments and the return of the bond's face value when it matures. They are considered safe because they are backed by the full faith and credit of the government. A key advantage of government bonds is that they offer a reliable source of income. The government is obligated to pay bondholders interest on their investment at regular intervals, which can provide a consistent income stream. Furthermore, they are generally seen as low-risk investments. This is because the government, unlike companies, has the power to raise taxes or print money to pay its debts. However, while government bonds are generally considered safe, they are not risk-free. For instance, bonds are subject to interest rate risk. When interest rates rise, bond prices fall, and vice versa. Also, if you need to sell your bond before it matures, you may receive less than its face value. Inflation is another risk to consider. If inflation rises significantly, it can erode the purchasing power of the bond's fixed interest payment. Real estate. The allure of real estate is difficult to resist. It is a tangible asset, one you can see and touch. Real estate investment can take many forms, from buying a home to live in, purchasing rental properties, or investing in real estate investment trusts or REITs. When you buy real estate as an investment, you have the potential to earn a return through income in the form of rent and appreciation, which is the increase in the property's value over time. Also, real estate can serve as a good hedge against inflation. As prices rise, so too can the value of your real estate and the rent you can charge. However, real estate investment comes with its own set of challenges. Property requires maintenance and management, which can be time-consuming and costly. There can also be periods of vacancy where no rent is coming in, but the expenses continue. Additionally, the real estate market can go through periods of decline, which could result in a loss if you need to sell. Digital cash. Stepping into the modern age of finance, we find digital cash, an innovation shaping how we perceive and use money. One form of digital cash that has been making headlines is cryptocurrency like Bitcoin and Ethereum. These digital assets rely on blockchain technology and offer a decentralized alternative to traditional government-issued money. Digital cash, especially cryptocurrencies, have several potential advantages. They are easily transferable, often without the hefty fees associated with traditional banking and money transfer systems. They are also accessible worldwide, making them especially beneficial for regions underserved by traditional banking infrastructure. Moreover, cryptocurrencies offer potential for high returns. For example, Bitcoin, the most well-known cryptocurrency, has seen massive price increases since its creation. However, it's crucial to understand that the value of digital currencies can be incredibly volatile, experiencing large price swings in short periods. It's also essential to consider the lack of regulation and potential security risks. While the anonymity and decentralization of cryptocurrencies can be appealing, they also mean there's typically no recourse if your digital cash is stolen. Plus, while digital cash can be convenient, it's also a relatively new concept, subject to regulatory changes and technological risks. As always, thorough research and due diligence are your best friends when exploring new investment avenues. The stock market, an ecosystem of buyers and sellers trading slices of ownership in public companies, often synonymous with high risk and high reward. Investing in stocks can offer significant returns, but it's also paired with higher risk compared to other assets. When you buy shares in a company, you're essentially buying a piece of that company. Your investment can increase in value as the company grows and prospers, or it can decrease if the company struggles. Stocks have historically provided substantial returns over the long term, outperforming many other asset classes. They can offer potential capital appreciation where the value of stocks increases over time. Moreover, some stocks provide dividends, which are regular payments given to shareholders out of the company's profits. However, investing in the stock market comes with its fair share of risks. Market volatility can cause stock prices to fluctuate dramatically, and the value of your investment can go down as well as up. Also, the performance of a stock is tied to the success of the company, meaning poor company performance can lead to a drop in stock value. Additionally, certain sectors may face industry-specific risks. For instance, tech companies might be more vulnerable to regulatory changes concerning data privacy. To mitigate these risks, diversification across different industries and company sizes is key, which can be achieved through individual stock selection or via exchange-traded funds and mutual funds. Mutual funds. Let's now turn to mutual funds, a popular investment vehicle designed for investors who seek diversification but may lack the time or knowledge to construct a diversified portfolio themselves. When you invest in a mutual fund, you're pooling your money with other investors to buy a wide array of stocks, bonds, or other securities, all managed by professional investment managers. Mutual funds offer several benefits. First, they provide instant diversification. Even if you're only able to invest a small amount, your money can be spread across various investments. Secondly, mutual funds are managed by professionals. These experts have the knowledge and resources to analyze markets and make investment decisions. However, it's worth noting that mutual funds also carry risks. They're subject to market risk, meaning they can lose value if the overall market declines. Moreover, just as with individual stocks and bonds, your investment in a mutual fund can decline in value. Finally, mutual funds charge fees, which can eat into your returns over time. Another key consideration is the choice between actively managed mutual funds, where managers make specific investment decisions with a goal of outperforming a benchmark, and passively managed funds, like index funds, which simply aim to replicate the performance of a specific index. Each approach has its own pros and cons, and the choice between the two will depend on your individual investment goals and risk tolerance. Gold and precious metals. Finally, let's explore gold and other precious metals. These assets have served as a store of value and a symbol of wealth for thousands of years. Today, investors buy gold and other precious metals as a hedge against inflation and currency fluctuations. One of the key advantages of precious metals is that they're tangible assets. You can hold a gold bar or coin in your hand, and this physicality provides a sense of security. Moreover, precious metals often perform well during times of economic uncertainty, making them a potential safe haven. However, like all investments, precious metals have their downsides. They don't generate income or dividends, so the only way you'll make a profit is if prices increase. Also, while gold prices can spike during times of crisis, they can also fall when economies are performing well. Moreover, there are costs and considerations associated with storing and protecting physical metals. Alternatively, you could invest in a gold or precious metals ETF, which offers exposure to the price movements of the metals without the need to physically own them. In conclusion, it's important to remember that investing always carries risk, and it's crucial to do your own research before making any investment decisions. Also, diversification or spreading your investments across a variety of asset classes can help to mitigate risk and increase potential returns over the long term. So there you have it. Remember that investing isn't just about growing your wealth, but also about protecting it. By understanding the benefits and risks of different assets, you can make informed decisions and build a diversified portfolio that aligns with your financial goals. The bank may not always be the best place to keep your cash. Let your money work for you, generate returns, and secure your financial future. If you found this information useful and learned something new today, please show your support by hitting the like button. Share this video with your friends and family. Let's spread the knowledge and make financial literacy our common goal. Until next time, we'll see you on the next video.